Good afternoon, everybody. Uneducated Economist here. So the Federal Reserve has decided to maintain the elevated interest rates with promise that there would be more interest rate hikes coming into the future. And I know this comes as a surprise to a lot of economists out there, a lot of people who follow the economy, following the markets. They believe that the Federal Reserve was going to reverse course, or at least give the signal that they may be reversing course coming into the future. But that's not the case. The Federal Reserve has no intentions on dropping interest rates anytime in the near future. They are going to keep them elevated for a significant amount of time, and this is something that we have talked about many times on this channel. The Federal Reserve is mandated to do two things: low and stable prices of around 2% inflation and full employment. So now the full employment part, this is kind of tricky, because what is full employment? When I think about full employment, I think about anybody who wants a job can have a job. Now, just because there's a job out there that's available for somebody, but they're not taking it, doesn't necessarily, to me, I don't necessarily look at that as like full employment, or that the employment that is available to these people is adequate enough to sustain their life. Like, you're going to go and get a job, then try and maintain an apartment, car, insurance, all the stuff that comes along with having a job and a life and all that stuff, and it's just not adequate. Like, the job doesn't pay for the standard of living that most people would want to have for having a job. So they just fall completely out of the jobs market altogether and become homeless, or, sleeping on, taking the charity of other people or something like that, sleeping on their couches or in their basement or something of that nature. So when it comes to like full employment, I don't think like the country is necessarily in a full employment, but we do have very low unemployment. And so that can be the indicator that a lot of people will look at, including the Federal Reserve, as the full employment is the same as having low unemployment, right? Even though I don't necessarily think that would be the same thing. However, low unemployment is the case that we are sitting in today, and now it leaves just the other mandate of the Federal Reserve, which is low and stable prices. And that's what they are working on right now. We have elevated prices still within the system. People are talking about the inflation as still running quite rampant through the economy in many places. You can find, all the inflation that you want. You just go down to the store and just pick it out. What a lot of people don't necessarily look at is a lot of the issues that are coming up as far as a deflationary or even stagflationary situations that are happening. One of the deflationary issues is within chicken and pork, and we've done reports on this just recently, where the overproduction of pork and chicken during the pandemic and the shortages that had happened, right, the elevated demand for chicken and pork, had the producers overproducing. And now there is not a lot of demand for this overproduced pork and chicken, and the prices are starting to fall. And now this is the bullwhip effect that's really happening within the economy, and it doesn't happen at the exact same time for everything out there. It happened in lumber, years ago even, and now we're starting to find it happening within chicken and pork. We found it within eggs. We're going to find it within a lot of other items out there. At the same time, we're also going to start seeing shortages happening within, a lot of the items that are just not being produced and sent over to the United States. So it's not necessarily going to be just like everything all at once is here's the deflation, right? Or here's more inflation. It happens in various places within the economy. Point being is that the inflation, or the official inflation number, if you want to believe that, is still quite elevated, which gives the Federal Reserve the ability to keep those interest rates, the Fed funds rate, elevated in order to combat those high prices. Okay, so really when we think about like where it is that the Federal Reserve is going to try and position the Fed funds rate, it's not the unemployment rising that we're concerned about. It's prices coming down that we would want to look at. And now when we think about like supply chains being broken down, we have issues still within the manufacturers throughout the entire globe. And if that doesn't bring in the ample supply, then we're going to have supply-demand imbalances. Right? So if we have supply-demand imbalances and the demand is higher than the supply, the prices will remain elevated. Right? And that gives, again, the Federal Reserve the ability to keep the interest rates elevated, trying to combat the symptom of inflation with the higher prices that are in the economy. Okay? So again, when I think about what the Federal Reserve is planning on doing going into the future, they're not looking at the markets. They're not. I mean, they might be looking at markets and the housing market and the conditions that are occurring within it, but that's not their main concern. Their main concern is low and stable prices and full employment. Right? Those are the two concerns that they have. Getting the prices down now seems to be what is going to be the indication of where they're going to move their Fed funds rate next. So long as we have the broken supply chain, like we still do, we are going to have issues within the supply and demand out there. If we have supply and demand issues, we're going to continue to have elevated prices. If we have elevated prices, we're going to have the Federal Reserve continually keeping the interest rates elevated at the Fed funds level in order to combat those high prices, which is due to a broken supply chain. That's really what's happening. So now we can see the repairs taking place within the supply chain. The freight itself, that was like the big one, how to, get this stuff around the country efficiently. That's really what was driving up a lot of the input costs going into the production and the delivery of these items that was going out there for retail. A lot of it had to do with that freighting, right? It was like taking a container from China, shipping it all the way over to the United States went from like $5,000 for each shipment up to like $25,000, $30,000. It was like 5 times the amount of input costs going into the distribution of it, just the transportation of these items. Well, that's becoming a lot cheaper now. We're finding that freight's coming down dramatically. Those shipping containers from China coming over to the United States, that has dropped down dramatically. It's back down to pre-COVID levels. So the input cost of a lot of these items has come down quite a bit. Here's the major problem. All the stuff that's already in existence here has high input costs going into it. It makes it very difficult to lower prices. What you have to do is work through all those elevated prices, all that high input costs. It's either that or go out of business. Now, there are a lot of companies out there who will be able to, bleed a lot of that out by lowering prices and taking a loss, but they're not going to be able to do it in such a capacity that they are going to be able to just all of a sudden, boom, bring in the cheap stuff and actually significantly lower the prices again. It takes time to work through all this stuff, especially if you have a condition in which that the Federal Reserve is trying to push down on the consumer out there. Right? So this is really what you have to look at, is where the distribution network is, the manufacturing of it, how those things are making it to the shelves, and whether or not the supply and demand is now in balance again. Right? Because that's really where the Federal Reserve is going to be making their next move. If unemployment rises significantly, right? Super significantly, like all of a sudden everybody's like losing their jobs and they're, pulling their hair out trying to figure out how to pay their bills. That would be something that would trigger the Federal Reserve to lower rates. And if all of a sudden we did have price inflation, like the consumer price index or whatever, starts to come down dramatically or even start to turn negative, then the Federal Reserve might take a pivoting position. But until that happens, until unemployment rises or we see a significant drop in prices, there's no way the Federal Reserve is going to do anything but keep the elevated interest rates for a significant amount of time. And then even if we did have inflation come down to their 2% target, it's not a target anymore. It's a 2% average inflation rate over time. And they don't give us an exact clarity on what over time means. Right? Is it the last 10 years? Is it 5 years? Did you start this idea like 2 years ago? Is it started like when the pandemic kicked in and the first, inflation took off? Where is the average inflation? How do we figure that part out? Now, since we don't really know that, it becomes arbitrary to the Federal Reserve when they say, hey, we've achieved our successful mandates, we're at our 2% and we have full employment, everything is awesome, right? We're ultimately left to the Fed's decisions on when they say, hey, we have achieved our 2% inflation target over time. We can now adjust interest rates. So focusing in on the markets, focusing in on administrations, like, we got an election year coming up, the Federal Reserve would never do this, that, or the other thing. I don't believe that. I think the Federal Reserve is mandated to do two things, right? Full employment and low and stable prices. And so long as you have unemployment as low as it is, they're not concerned about the jobs market. Excuse me. And as long as we have prices elevated, interest rates will stay elevated. Uneducated Economist, you let me know.